Good afternoon. Coming to you from Traders Community. It is December the 16th and a big reversal day across the markets. We spoke about a lot of this morning. The potential didn't look like it could happen today, and that's why we stick to those rules. So a bit of a make your day as the iconic picture of Dirty Harry didn't muck around today, did he? So let's get into it. As far as the end of the day, we started up at record highs pre-market on the S&P. By the day's end, the S&P finished down 41 handles. The NASDAQ was the weakest, fell at 385 handles. The Dow was up most of the day, gave it up near the end there, finished down 29 handles. The 10-year note was up 3 basis points at 1.424 yield, giving a yield of that. On the NASDAQ, this is the tail of the tape. There was 1,557 advances versus 2,890 declines on 4.8 billion. So a lot of reversals there. Apple itself reversed hard, as you can see. It was trading 181 pre-market, got us under 171 during the day. That's a $10 fall that a lot of people are getting spun on. So basically the 2-yield dropped and it outpaced the decline in the 10-year yield. So in other words, the curve shifted again. So let's, without further ado, let's go through the chart. So what happened? So our favorite here is always the daily S&P. So what happened overnight at the end of the day? We ran hard yesterday. Remember, up, down 3, up 3. We questioned what this would be. Right? Is this ABC to this high, or is this a 1, 2, 3? The relevance is in the bigger picture. So what we did was go to new highs, and we gave it back. We didn't quite get to our daily tanking, but very simple rules. Previous highs, the failure was kicked in here this morning. Okay, on your daily, you can see that bigger picture. Everything's still alive, though. You should draw your wicks for your top or your neckline, whatever you want to call that thing from the bullish point of view. Bearish, this is your pattern, right? A, B flat, C is down here. This needs to hold all this business right here, okay? We go to our hourly, which is more distinctive. So we got overbought. We went back to our plus 2H as we were talking about this morning. And to respect that, we were looking for an ABC. If you recall, we'd got taken profit on this little beauty. So 1, 2, 3, 4, 5. Did that complete an ABC, or was this the first wave up? Well, Elliott wave rules. We can't go much lower than this, can we? If that's what you want to call it. Look what it did in even 5 waves, right? That is not an ABC. That can be an A or it can be an X wave. Now look at that channel that keeps holding. Well, it didn't actually get there today to actually hold. Close enough. You could argue when we look at the Murray and everything else. Okay, and particularly with this little fractal there, it's equidistant down here. Okay? Adams rule, though, it breaks. Potentially can do the same move down here, which would put us a replica of that and that. So bear in mind tomorrow, those moves, tomorrow's quadruple expiration, meaning options, stocks, futures, and options on stocks. So there we have that. 5-minute, real quickly. So you have a closer look at that. So it wasn't cut and dried, this buy here. As I said, it didn't get into that channel, right? And it didn't quite get to 08. So to me, that wasn't a good buy. I actually chose, when I get that situation, when it's that close, and vol is still pretty cheap, I go towards optionality, i.e. buy calls, buy puts, you know. So here you're buying calls. You already have puts on from here, and then you can cover that on. Now, Apple. Apple was the destruction. This was your dirty Harry of the day, right? So we opened up this morning, and it was up. He was already red, and so that was our first targets on the downside. It didn't even give up on the 60-minute here. Well, look at 40. Look what it broke. This support. This was a breakup from yesterday. That was your kind of easy short if you're more aggressive. You know, if you weren't in here, because it didn't get quite to plus 2.8, but it did, if you remember from this morning. I was talking about that being the breakdown line. So we retested that. 1, 2, 3. Perfect, right? 1, 2, 3. Perfect ABC here. So it's your A, your B, and then you got a C. Bigger picture, this can be your big corrective wave to go up. So all your rules are there for Elliott people. Keep it simple too. Let's go to 4 hour on this. On the 4 hour, look what it hit. And I kind of joked this morning, but it actually hit it. See, that's the thing with maths and possibilities and the beauty of options. What doesn't look possible can often happen, right? Nothing is as it seems. And you've got a market that really nothing's changing too much. In the bigger picture, we got all the negative that focuses on the downside, right? The variant, inflation, stuff like that, rising rates. That's all forgotten when this happens by the herd or the sheep or whatever you want to call it. So buying begets buying, selling begets selling. Keep it simple. And there was a great Twitter, someone joined us, commented on Twitter, I believe, last night. And we follow him, lots of good, clever in the reactions, and we follow each other back. So it's MI8 _ MI8 is his handle. I've never worked out if that's, and I should ask him or her, if that's mate versus mate. I'm not sure. But he made a comment that when you get these kind of moves on a Fed day, it's often ignored. So the way I trade them is kind of like a day trade, go with the herd. And a lot of other people just simply ignore it around their positions. I tend to not do that and tend to keep going. And this is as we chatted backwards and forwards on Twitter, and see if you want to watch it, look it up. That it's different this time of year. This is coming at Christmas, QE, etc., etc. But generally, it either gives it up that day or the next day. So that's kind of what happened. So that's good insight from it, and thanks for that if you're listening. Great little chat there. Now let's go on to the NASDAQ before I bring Alex and Madavi in on this. So this was brutal. This started, obviously I just showed you Apple, which is 11% of this thing. But this was a lot weaker than S&P. We saw a lot of S&P stocks hitting 52-week highs. Procter & Gamble was one, Pfizer another. So that obviously wasn't in this index. So you can see how weak it was. It came all the way back to yesterday's breakup. The first time you ever had a buy on any technical thing that I look at was around here. But remember, Nova Wave isn't just technical. It's looking at crowd behavior, Elliott, and order flow, right? And as you know, Madavi trades a lot of order flow. He's very more watches the order boxes and all that, more pit trader type thing. So we came out technically. You got a kiss of death here. You got kind of one working here, but look at this, and it accelerated down, and it never got back over the Tenkan all day. So that's a bit of a mess. It needs some help, that one. And before we bring them on, I just want to show the other one. Russell yesterday gave a lot of people hope, right? It was the weakest all day, and then it showed some love. Just bludgeoned all day. It did have some green here. These are 30 minutes, yes, on NASDAQ and Russell. I don't trade either of these futures. They don't cover the spreads I like, but I obviously keep an eye on them. So look at that. Almost identical to NASDAQ. There's your breakup. It came all the way to -3/8. That's pretty weak. So let me pass the baton over to Alex and Madavi on the NASDAQ. Let's bring the chart up. We got Madavi there? Alex?
Yeah.
Yeah. Do you want to on
So,
the NASDAQ I got up for you, mate?
yeah, I see that there. Thanks, mate. So today was a day where the NASDAQ really couldn't get out of its own way. Despite opening strong with a gap up and a lot of bullish pre-market action, this was a market that was content to fade yesterday's gains and in some cases a little more. Some speculate that yesterday part of the action was a vol crush, and so we had a little bit of a reversal of that. But whatever the case may be, the market's continuing to digest this pivot by the Fed to accelerating taper, and at least for today, rate sensitive high beta issues, which are the majority of the NASDAQ, were really out of favor. And, the NASDAQ just continued to sort of sell off throughout the day. There were a few brief reprieves, including up into the close, that last half hour bar kissed the tankin, couldn't get above it, and faded back down. So, the real play of the day was just shorting the NASDAQ and going with the trend. It was a trend day after the start of the day. Everything just kind of melted lower, and the Russell and the S&P behaved similarly, but it was really the NASDAQ that was the loss leader today, and the Dow was the strongest index. So, I think that there was a little bit of excitement yesterday with the reaction to the Fed. I think some people thought maybe this was an all clear. And so there was a lot of buying, there was some short covering, there was some removal of hedging. And today we saw pretty much the inverse of that. I think, if people were hopeful that this was the bottom, we may have more exploration to go to see if any of these levels that we had explored yesterday and the day before are actually able to hold. I should just say yesterday. So yesterday you could see on the chart we had this double bottom. That's where that red Murray math level is there, I believe. And so when we made that double bottom and were able to break above 16,000, you saw momentum come in a really strong way. Just like today, when we started breaking through some of those key levels, like 16,300 and then 16,000, we saw that pretty much given back. So going into tomorrow, we've got quad witching. It's going to be probably pretty volatile. You've got a lot of gamma rolling off the various indices. I think it's something like 40-50% in the NASDAQ. So I would recommend, anyone who's trading, if you're not experienced, be nimble. If you are experienced, be nimble. Could be choppy out there.
Yeah, good advice. I mean, I made the decision about 6 weeks ago pretty well. You know what? This is the wave. I think it is. I'm not touching anything other than I might have done the odd one, but pretty much the S&P, Apple, oil, natural gas has been pretty well it. Because there's so many unknowns or road bumps or this sort of thing. And you don't want to, so we're limited with the edge we have anyway, with experience versus machines versus big order books. So you want to be wary of that type of thing, that's the unknowns. So that's technically very nice. And we look at the Russell, or that was the Russell, was it? So we moved, no, that was they do look identical today, don't they? Yeah, so this here's the thing with the Russell today. Once it broke here, and this is a classic kiss of death, there and there, it never even came back. It didn't even try to actually, did it? Look at that. So that's the sort of thing Alex is talking about. You just don't know in those indexes and what makes them up. Can you hear me now, Madavi?
Yeah. Can you hear me?
Yep, yeah, hear you perfectly. So let me put up the NASDAQ again. You weren't coming, I couldn't hear you before, sorry. But here we go with the NASDAQ and more your trading side of it. What did you see on that?
This morning I started trading pre-market and I was thinking the market is going to go down. But the market ran up with me, so it kind of threw me off. So it kind of, starting the day, I was kind of way behind the 8 ball. And then the market finally broke. I got back on some streaks, but I was playing catch up all day. So
you're talking about this move here, because you trade up a lot earlier than me. I tend to come in about 7 o'clock kind of thing, my time, whereas you're already up and going. So you're talking about that move there.
Yeah, it was a big move, but I didn't think this market could rally. I thought it would sell off like this, but it caught me in like the popcorn machine. So you gotta always watch uh, your risk out there. So you gotta sometimes, even though you're gonna be right. So, but you
Yeah,
always
you
have
got to
to.
manage that. Yeah.
So I started then started making a comeback. Then I got chopped around a little bit and took a little break. But I got some good stock calls in the day. We got that Muddy Waters report on that BEKE.
Yeah. That was a nice one.
Yeah, when it first came out, it was like I don't know, like 19, $20. I shorted it there, got out around $17 or something, 17.80. Then I waited for it to go up a little bit, and then I shorted it. Then I seen it going back up, so I went long it and all the way to 21, then shorted it again, and I wrote a bunch of options on it. I'm holding those, some for 18 at 17.50 and some at $20. So we'll see how that ends out the week tomorrow. They'll expire tomorrow. And I got out of the shorts I was in stock wise, but I'm holding the options. You never know what these things could do. And at the end of the day, it was, I thought we were going to sell off, and we did sell off, but I was hoping for more of a dramatic sell off like we had the gains yesterday at the end of the day. So tomorrow it's going to be triple witching. I'm not sure what this market's going to do because of the options. I'm hoping, we basically, the last 2 days, we're basically flat for up and so we're back to
Right. We've
where we
come
started.
right back here and totally rebalanced to this breakout. Yeah.
Yeah, so this is a total screw job for the longs and the shorts. So,
Yeah, and the
and
way I've played it option wise, given it is quadruple, I actually rolled things that I still had it in the book today before lunchtime. That's pretty well when vol dies. So if you want to stay in that position, you roll it forward.
after the
Yeah.
market, we had that Rivian come out. I shorted that, made a little bit there, and FedEx, I went long. Good thing
Yeah,
I got
both
out
earnings reports, right?
where those are earning reports, and the Rivian's down below where I got out, but that FedEx is lower than where I got out. So
Oh,
uh,
nicely done.
yeah. We'll see what happens tomorrow. It could have been better. I just in the day was in the morning got off to a rough start. And that's why
Right.
I'm going to play catch up.
Great, thanks for that. Before we bring Nick on, we're going to look at some options on Apple, and the SPX. But just want to go through oil. Oil is still in that consolidating mode. Here's your daily. Although it bounced nicely and held on to it. So it bounced yesterday of S&P and didn't give it up. So we're trapped in there on the hourly. There's no real significant news as far as that goes. You do have SPR. The tender on that out tomorrow. That will have an effect. Where is my hourly chart to kind of show you what went on? So it did topped out a little bit down here. That's your ran a little bit higher when S&P was falling. Held on to these levels right around the tank and above it. And if you want to look where we did on the pivots, I know a lot of you trade off that. We didn't even get down to the pivot. See that? We just hung around the 5-minute tanking. There's your R1 giving you didn't quite get R2, right? So it wasn't a real good trading day on oil. On natural gas, we had the EAA number. It wasn't tight enough for the market, and it sold off all day. Remember we talked about we're at record wind production right now. Remember there's more than one source of energy, right? Another gift from Texas to America, I think, that wind. But anyway, we won't go on. Look what we did. We finished right here. If we get more bearish weather, we have all these stops under here. Price action people have on with options. This is 2 to 3 months, someone was mentioning today, since that high. So again, that's the turn of the year for natural gas. Let's bring on, where is that? Let me find that. And I will put it up. So if you want to, while I'm finding that, Nick, if you want to
Yeah,
try and
no, like
answer
not
that.
too much to add today. I think just very briefly and touching on what Davi said on the BEKE, it's very interesting because when that report came out from Muddy Waters, it seemed pretty damning. I mean, I can't really comment too much on it, obviously, but in terms of the how true it is on the underlyings, but it seemed pretty damning. And pre-market, you saw that sell-off. But what do you know? Right at the open, and then Alex saw it right away as well. So huge call buying come in, and if one had to speculate, perhaps it's sort of the people are feeling or traders are feeling a bit. Let's say not super friendly with a lot of these short sellers and the firms that put out this research, perhaps. Anyway, you saw what could potentially just have been people trying to squeeze them out. So called it maybe for 1 or 2 hours. I mean, the stock rallied like 60%, and then it started petering out. And ultimately, at the end of the day, I think only a few percent down from memory. So that was quite interesting. Just to add to what David was saying. Yeah, now an app.
And I've actually got your spider one up first. If you
All
want to
right. Okay.
talk through
Well,
that.
the Apple one was perhaps a bit more interesting, but
Well, I'll
yeah,
find that one.
they
But if you can
yeah, no,
talk
no
us through
worries. I think
that, because I
I
thought
think
that
this
was
one could get the
good,
miss.
showing the convexity of vol as things go up and down. You can see from yesterday's rally to today's collapse. If you want to walk us through that on your skew there, it looks pretty interesting.
Yeah, no, exactly. I mean, it looks a bit more dramatic on Apple, not dramatic, a bit more exaggerated on Apple. But yeah, I mean, you can see as although here it's a bit more interesting in the sense of you have skew coming down broadly, with the market going down in general today. I mean, it wasn't a huge move,
Look at this.
but
Look at this
still,
right here.
yeah, that was interesting. So that little pop in volume there.
I think Alex
Uh,
mentioned that too, that massive buying. So the trouble is we don't really know what it is. We're speculating, but that's a massive buy. My gut feeling that's part of a big roll and book for tomorrow, end of the year, uh, and they chose to do that there. And look at the time when they did it. So when they could get that volume done in time, right? So, but that
mhm.
was a massive volume, and we
Yeah,
see
that's an
it coming
interesting one.
down there. So let's bring up the one you want to look at.
Oh yeah, no, it's so on Apple. I
This is
mean,
a
it's a
little bit
similar.
more interesting, right? But it's
Exactly. I
similar, but
think.
there we go.
Yeah, I think the biggest. I mean, just visually, the biggest takeaway here is both calls and puts. I mean, look at that. It's like 4 or 5 volt points between the open and later
Yeah,
on in
look
the
at that
day in
kid.
terms of IV. Yeah, and yeah, skew was just bobbing around back and forth. Um, and yeah, I mean, ultimately at the end of the day, there you see skew coming down. Calls being more expensive relatively. But vols. I mean, again, no surprise. Vols on both calls and puts were just
Yeah, so this
significantly
went from
higher
a
today. I
20
mean,
volt to a 70 volt in the last 2 weeks, which you'd expect with
yeah.
the movement, but it also means these sort of moves create fear and uncertainty. But look at the size of the volume. So remember, calls and puts, there's a buyer and a seller. You get a lot in these rooms that trade these thinner ones, and they think if there's big volume, I mean, it only goes up. Well, there's a guy on the other side of all that too. And in something like Apple, you got some of your best in the shops. Like I mean, as in your banks, right? Investment banks, hedge funds. So you can see that. And from a pure, as we saw in the technical, you can see that here, we couldn't go higher. But look at this negative divergence. You had higher volume on options and a lower high here versus that. That's an old giveaway that what was going on in that optionality there as well. So interesting story there. And you watch the types, the tape, etc. on that, and you got your deltas down here. Any other thing you want to add to that, Nick, or any
Not from
questions
my side.
coming
I think it
through?
was an interesting day. Tomorrow will be the real sort of the interesting day to see what happens.
Right, and some of
Yeah.
this and some of that crazy volume we just saw inspire a lot to do with what's maturing tomorrow and quad witching. And these are all
Yeah.
parts of bigger books. And I'll give you a little tip. I often see on things like FinTwit on Twitter or the what's that one? The stock. Anyway, the stock rooms. I can't think of it right now. But JP Morgan's doing this or Goldman's doing this. I'll give you a little tip. What they're doing they only want you to know if it suits them. So be very careful of the information that's shared out there, right? Don't believe it all. Don't believe the hype, as Flavor Flav would say. Believe he's a good Houston boy. But
Absolutely.
so I wanted to bring back and talk about bonds with Alex, because we had multitude of banks today, and they're on the website, but we had S&B from Switzerland, unchanged, and it's been a long time, negative rates. Main thing there was the currency. We had the Bank of England raise rates a tad. We had the ECB left rates unchanged, but changed their mix or their blend for QE. What else do we have? The Mexican Central Bank raised rates, I think a 0.5%. And of course, more turmoil over in Turkey. That very sound, stable leader, Erdogan, fired a couple of his finance ministry last night, came out and they cut interest rates by another %. You've all seen the chart on the little Turkish lira there. So that's that. Bonds did react. The curve shifted back a bit on the US Treasury side. Alex?
Yeah, so, yesterday in response to the Federal Reserve, we saw the bond market not really price in the level of rate hikes or even the acceleration of tapering. So it seems like there was a little bit of doubt, and that kind of continued into today, quite frankly. The 5s and 10s were the strongest bid, so the yield curve is starting to look just a little bit different. Yesterday we saw a little bit of steepening. Today we're seeing a little bit of flattening. And the other thing that I noticed was, high yield spreads really didn't price in the kind of, increase in tightening schedule that the Fed had suggested. Neither did corporate debt. So it seems like for whatever reason, the credit markets are kind of calling the Fed's bluff. From what I can tell, they seem to be more of the mind that, maybe there'll be 1 to 2 rate hikes next year, maybe. And really no decision as to whether there's going to be continuity for that. So maybe the bond market is starting to realize, and this was even before the Fed discussed an acceleration of taper, the way that things were being priced, that the slowdown of economic growth that's happening both globally and here in the U.S. Is something that's going to continue and perhaps worsen into next year. The other thing that I've noticed that I think is an interesting counterbalance to this argument is if we do see normalization of rates, there's over 3,000 companies that could be in pretty difficult trouble, and because of that, and we're talking about the ones that are more rate sensitive, that have higher degrees of debt, and that are less credit worthy.
There could be. Say, Alex. Yeah, that's a big number, isn't it?
Yeah, and this is one of the things that Scott Meinard of Guggenheim Investments has brought up too, that he thinks the next recession is probably going to be a credit event that starts in the corporate sector, because the amount of corporate debt that needs to be refinanced within the next year or two, and there's even more in the next 2 to 5 years, and the amount of corporations that have existed in this artificially abundant environment of liquidity and low rates, that many of them may have unsustainable debt loads that lack profitability. So there could be a bit of a cascade effect here, because to some degree all these markets are interconnected, and so are all of these companies. And so I think that we may find, and of course I'm just going out on a limb here, but I'm looking at what the bond market's telling me, and I'm looking at some of this macro data, hundreds of trillions of dollars of global debt, over 150 trillion of that very rate sensitive to the 10-year bond. It seems to me that the market is sort of discounting the Fed, that because Jay pivoted this way, maybe the market's saying, well, why can't he pivot the other way? And indeed, during the presser, which was kind of like we had the bad cop in the policy statement, and then we had the good cop, Jay Powell, in the presser, he repeatedly made assertions such as, if we see the economy slow, we may change our tightening schedule, in particular as it concerns rate hikes. And I think the bond market was paying very careful attention to that language and saying, well, shoot, we already see the economy slowing, so why wouldn't that be something that, Pivot Powell, as we might start to call him, because this is the fourth pivot in his term, Pivot Powell may indeed kind of walk this back next year if we see economic growth continue to slow. And, retail sales yesterday wasn't great, but we've had some other econometric data that was also, some of the stuff that came out today wasn't so hot either. So I think it's going to really depend on the data. I think we're going to get back into an environment where bad news is good news because the Fed has made it clear that the abundance of liquidity is directly correlated to the health of econometric data. And we, going back to where this all started, everyone should sort of consistently remind themselves that this is no normal credit cycle. This is sort of the tail end of the post-Great Financial Crisis 2009 credit cycle. And so we had the Fed kind of rejuvenate that cycle. It was already beginning to sort of end on its own accord in 2019. And now I think they bought a little extra time. But at the end of the day, this credit cycle and the potential recession to come, as we've been discussing, it could be something that happens as early as late 2022, early 2023. And so there's some of that kind of being priced into bonds, I think, especially in the U.S. So something to keep an eye on. I noticed, Andrew, you put the MOVE index on the screen.
Yeah,
I think this is pretty
wanted
interesting.
to share that you put up on Twitter a little while ago. And remember, if you're not following Alex on Twitter, make sure you are. He puts up some great economic stuff as well as market stuff. But that's at Mayhem 4 Markets, the number 4. But if you want to, that's an interesting one. If you want to talk about that for us.
One thing I want to note, because Andrew and Madavi and Nick and I have talked about this at length off video, but the bond market tends to be more in tune with macro and data and liquidity than the stock market. It's usually the bond market that reacts first, and then the equity market follows. And so we're seeing a drop off in volatility as measured by the MOVE index. So I think it's important to note that, because this was really the leading indicator that perhaps the equity market was going to get in trouble. And indeed, we saw bond market volatility really start to ramp in September. As this chart shows, we were in the 50s. We got all the way up to the mid 80s. And so that's a pretty significant move in the MOVE index. And indeed, equity market volatility pretty well followed that. So when there's consternation in U.S. sovereign debt, when there's more volatility, when there's bigger price moves and yield moves, we see that translate to greater volatility in the equity markets. And it makes sense. I mean, if the cost of funding keeps varying and there's more nervousness about credit and, some of these other issues underlying, like, people are still thinking about Evergrande. They're still thinking about what's the next other big kind of event that may not be as buffered because there's less liquidity out there. That can drive that volatility on the other side of it. Now we're starting to see that drop off. Now we're below 70. That's the lowest close we've had in December, and it's bringing us back to levels we saw in early November. So we're going to have to pay attention to this, but what it suggests to me is, with the Fed behind us now, and with the price action in the bond market beginning to stabilize in what seems like is pretty bullish for the overall pricing of bonds moving forward. And so, we could see prices of bonds increase, which would probably bring up some of these other long duration assets like corporate bonds, like junk debt. We saw gold catch a really big bid today. I don't think that that's a coincidence. I think that that's another long duration kind of speculative asset that tends to move as real rates drop. And I'm just going to quickly check here as I'm talking where real rates went today. So today we saw real rates drop across most of the yield curve except for the 30-year note. So that's of note too, because yesterday real rates were at the highest levels that they had been for the entire month.
The 30-year bond or the 30-year bill?
The 30-year bond.
Oh, okay.
The 30-year bond. So when we look at real rates across the yield curve, all of them dropped today except for the 30-year bond. And what's interesting about that is yesterday we had the highest real rates that we had for all of November. And yet we had probably the best, December, and we had the best single day performance in these long duration competing assets, the high beta, really high volatility growth stuff, while real rates were rising. So that was a very strange trade. That's not typically what you're going to see, which further suggested that it was short covering. So, net, I would say it's really important to keep an eye on these rates, especially the rates on the longer end of the yield curve. I like to look at the 10, 20, and 30, both nominal and real rates, to get a sense as to the sentiment in the bond market towards the economy, as well as the abundance of liquidity. Deeper negativity on real rates tends to put a bid on more speculative assets and other long duration assets, and vice versa as they rise. So, to give you an idea, in December, the lowest real rate on the 30-year bond was negative 0.59, and the highest real rate was today, and that was negative 0.34. So that's a pretty significant move from that low to the high today. And I think that's another reason that we're starting to see, some people kind of look at these other long duration assets and saying, okay, do I need to reconsider how I'm managing my risk into 2022 when real rates may start to go positive? So, inside the bond market, we still need to observe, I would say, how we trade tomorrow, how we trade to close the year. But overall, from what I can tell, it looks like the bond market doesn't believe that the Fed is really going to be aggressively raising rates and is a little bit skeptical of the tapering schedule. At least that's the read that I get from the price and yield action across the curve.
Actually, you look at currency. So we had all the banks pretty well done, except for the Bank of Japan, which is out tonight. But the yen has been the weakest currency for quite a while, as far as this cycle goes in the past week that I was just talking about. But today, what I noticed more than anything, and I have the chart up there, is the dollar yen got pounded this morning, i.e. yen up, dollar down, which the currency markets tend to pick things up first, then the bond market, either or, stock market next, and the property market's usually the last as far as cycles and risk and all that sort of thing. So look at this dollar yen move this morning. That's telling you exactly what I was just talking about, lower US interest rates at the front of the curve, basically. Your forwards and everything impacts that. So that's going to be interesting. It's also a risk on and risk off measure. That went before the S&P, right? So keep an eye on that tonight. That's really the only news out tonight. Now, I hate to break the news to everyone, but you probably already know. But we have all these Fed governors going to start coming out tomorrow to follow up on the FOMC decision. They try to smooth it out, no doubt, with the way the stock market got pounded today after yesterday. They're going to try and talk about the faster taper without I guess scaring the market, right? You've got Waller out, and Fed Governor Waller, and the San Francisco Fed daily. Talk about a pivot. Daily went from it's transitory, and did a total U-curve, spin on that one, right? So she's out tomorrow.
Yeah.
Do these people have credibility anymore? That's another thing, but they could get the algos going. So I think they're talking, it looks like at the same time tomorrow, 1 p.m. Eastern Standard Time, so noon for us Central Timers. They're out tomorrow. We have the quads. We have the Bank of Japan tonight. Your President Biden was out applauding himself now. He's saying, this came out about 10 minutes ago, that the Omicron variant will spread much more rapidly, but because of my administration, we have really helped it in America. So that was his latest. So that keeps going on behind the scenes in the markets. Obviously, some countries are more fearful of it. Some people are managing it better. Do your own research and all this. It's such a hot topic. Anti-vaxxers, pro-vaxxers, pro-maskers, anti-maskers. Just use bloody common sense is my advice to the lot of you. It is flu season. It is cold season. But it keeps being used for reasons, personal opinion here, to kind of brush over everything else that's going on. Unfortunately, the ilk of these type of politicians is about partisanship, scaring, controlling, all that. But that is out there in market situations. It does affect us. It does affect Pfizer, for example, 52-week highs a day. What do? They have the pills, they have the vaccines, etc. This stuff is real, how it affects your finances and trading. So try and understand it. And remember, you're trading. As I said yesterday, what these guys do don't let it influence the way you make a financial decision for your own being. These blokes shut down the world's economy for 2 years. Do you think they really care about your financial well-being? And they managed to get people to think that way. So it's all okay. Use common sense. If you're sick, stay at home, all that sort of stuff. Just use common sense. Anything else, guys? I think I covered what's coming out.
Yeah.
Anything else? We talked about all the central banks. Plethora gave where the different levels are. Beware of them. We'll be here in the morning. And that's about it, really. Anything else? Johnny's not here, so we don't get a Bitcoin update.
So the only thing I would add in is one thing that's unusual about this month. Typically, volatility product expirations the third Wednesday of every month. This month, it's next week, so the fourth Wednesday of December. And we also have coming up tomorrow, and that quad witching. I got some of the numbers on the gamma roll off. So on the S&P, it's about 44% of gamma expiring tomorrow. On the QQQ or the NASDAQ, it's about 62% of gamma dropping off. And on the IWM or Russell 2000, it's about 55%. So that does pave the way for the holiday week with volatility product expiration to potentially be extra volatile. So, just another heads up. And if you're looking at my Twitter feed, Mayhem for Markets, you could see some more information about this.
Yeah, thanks for that. And make sure on your socials to follow us for different things, ask questions. So Traders.com, the overall, Madavi 4, Nick, Disintegration, I believe. And we have NovaWave just for the purely technical side of it. And of course, you'll see other people that converse on the different threads of those different socials. So you'll find plenty of people you can follow and engage with there that are, I was going to say of sound mind, but I probably shouldn't say that, right? Some of the things we see out there. But no real other trade ideas other than if you trade options, there'll be good optionality tomorrow. Often on Fridays, you'll get good gamma opportunities where the market gets too cheap of options and puts and calls. We did have a big sell-off today. We had a big sell-off 2 days ago. We had a big buy in between. So there's obviously a lot of big swings out there and risk moving around. It is Christmas. It's within 10 days now, so a lot of people are off the desk. A lot of people in holiday mode. Holiday mode usually doesn't mean big position taking and stuff. Anything else from anyone else? Like to finish up? Madavi?
One last thing.
Yep.
One last thing I'll mention in case anyone's interested in seasonality. I've got a couple stats that I wanted to just quickly go through, and this year may be an exception year, but December triple witching week. This from the Traders Almanac. S&P up 27 of 38 last year's, average of 0.5%. 2018 being the outlier, down 7.1%, that was a Fed week that year too. December triple witching day. S&P up 26 of the last 38 years. 2018 down 2.1%. And then finally, the week after December triple witching, which would be next week, Dow up 22 of the last 29 years with an average gain since 1991 of 0.9%. So those are some things to keep in mind. Now, obviously, past is not prologue. It can just sometimes give us an idea of probabilistic outcomes. So, that's something. One other thing that I'll also mention, this is also from the Traders Almanac, is you see some of the stocks that really were the losers sometimes get the bid from the back half of December through the front half of February, and it's summed up like this: investors tend to get rid of their losers near year end for tax purposes, often hammering these stocks down to bargain levels. Over the years, the Almanac has shown that NYSE stocks selling at their lows on December 15th will usually outperform the market by February 15th in the following year. Preferred stocks, closed-end funds, splits, and new issues are eliminated from this data.
Great. Thanks for that. Everyone, and the final thing, make sure you like and subscribe to the podcast. It really does make a difference to YouTube with their algorithms, etc., and what we're able to bring you. That's it. Have a great evening. Remember, always trade what's in front of you, and that'll keep you in good stead. Have a great day. Thanks, everyone, for joining us, and thank you from all of us. We will. I'd like to say I'm going to be up early, but I'll try. It is Christmas. See you all.
Take care, everyone.
But
Right.
And thank you, Laura.